What is going on, guys? Nick here, back with another video. Google has long been one of the slowest and least exciting of all the FANG stocks, but this last year has seen one of the most impressive runs, with the share price gaining over 76% over the last year, more than doubling the returns of the S&P 500 over the same time span. In this video, I'm going to take a look at Google's business and see what's driving the rally. I'll also take a look at the current and forward valuation and see just how much higher Google's stock price can actually go. So when you buy the ticker GOOG or Google, the company you're buying shares of is not actually called Google, it's Alphabet. In 2015, the CEO, Larry Page, announced they were creating a new company called Alphabet. Alphabet would own a bunch of companies, with the largest being Google. This would allow the Google operation to focus specifically on Google products, while Alphabet, the company, could invest in other non-search related businesses. Things like Access, the business in charge of Google Fiber, Calico, an advanced bioresearch company, Capital G, an equity investment firm, Nest, the home security company, and Waymo, along with a whole bunch of other companies. Now, Alphabet breaks itself down into three segments. The first is the Google Services segment, which includes Android, Chrome, Gmail, Google Drive, Google Maps, Photos, Play, Search, and even YouTube. Then there's the Google Cloud, which allows developers to test and deploy applications on its highly scalable and reliable infrastructure. This basically gives developers easy access to huge amounts of computing power. Instead of companies having to balance the costs of buying and maintaining servers with actually having enough computing power to run their operations, they can easily gain access to more resources on the Google Cloud when needed. Other bets are a lot of the small companies I mentioned earlier, but the segment allows them to put some of the cash earned from the profitable parts of the business into businesses that have the potential to become major businesses, like Google Fiber, for example. But the real star of Alphabet's business is advertising. Internet advertising as a whole is a huge business, with $356 billion spent on digital advertising in 2020 alone. Digital ad spend is forecasted to continue rapid growth, reaching $460 billion by 2024, and Google had about 29% of the total digital advertising market share in 2020. Digital advertising has huge advantages over conventional advertising through TV, radio, newspapers, or any of the other traditional advertising methods. It's far easier to target online ads through online advertising, especially towards people who are actively looking for a certain product or service at that exact moment. For example, if you wanted to advertise dog grooming services in your city, it's going to be far more difficult and expensive to run a consistent ad campaign bringing attention to your business through TV and radio than just running Google ads when somebody searches dog grooming services. CPM, or cost per milli, is what it costs to put your ad in front of 1,000 people, or in other words, 1,000 impressions. While CPM varies depending on a lot of factors, TV ads cost on average about $25 per 1,000 impressions, and daytime radio tends to be around $14. Google search ads, meaning the ads displayed in the top of search results, average a $38 CPM. But these people seeing your ads on TV or listening to them on radio may only be passively listening to your ad. I mean, it's possible that they even have the TV muted during the commercial, or they're just not paying attention at all. Google search ads are shown to people actively looking for the dog grooming services that your business is looking to advertise. The average cost per click for a Google search ad is only $2.32. So this means for an average of $2.32, you're driving high interest web traffic directly to your website. When you're converting those actively looking for services directly to your website, you have a much higher chance of converting that ad viewer into a paid customer, especially compared to those listening to your ad through radio or seeing it on TV. When we look at competition for digital ads, Google leads the pack with about 29% of the total market share. Facebook is in second with about 22%, and the next American company is Amazon, who's grown pretty quickly, going from 3.8% of the global market share to 5.2%. If we only look at US digital ad spending, Amazon actually took up 10% of the market share versus last year when they took up 8%. But nearly 90% of the ad revenue purchased on Amazon was actually spent on Amazon's own website advertising, meaning that the ad revenue is money spent on sponsored search results on Amazon and not actually directly competing with Google's ads across the internet. Of the big three digital ad companies in the US, they all have different strengths, and as an investor in all three, I really don't have much concern with them getting in the way of each other. The Google ad network is spread through millions of websites and has ads displayed on Google search results. Facebook ads are able to target very specific demographics and interests for ads that display on Facebook and Instagram. And Amazon is able to provide ads for people searching for a specific product on their website. Over the last year, Google's business has not gone the way that analysts initially forecast when COVID-19 hit. There was a lot of concern that businesses would conserve cash and ad budgets would be one of the first parts of the business to get cut. both Google and Facebook were seen as vulnerable since their revenue depends heavily on ads. Analysts were saying things like 40% of Google's revenue comes from at-risk areas like restaurants, travel, and offline retail, and they expected Alphabet to have a great near-term disadvantage. Others were saying they expected a weaker ad environment that's likely to continue until a gradual recovery unfolds in the fourth quarter of 2020. But the reality did not match up with these grim predictions. While Alphabet's revenue in the second quarter of 2020 did drop 2% for the same time in 2019, in Alphabet's third quarter, ad revenue growth returned. They earned $37 billion in 2020 versus the $34 billion they made in 2019. So let's take a look at how Alphabet's business is actually performing. Starting with their revenue and net income, we can see Alphabet has shown very steady and consistent growth. Even with all of the negative impact on the business last year, Alphabet really hasn't missed much. The last 4 quarters has actually seen more profit than any time in the past. It actually looks like revenue and profits have grown at a faster rate than they were pre-pandemic. Alphabet's expenses versus revenue shows that the majority of their expenses are from the cost of revenue. According to Alphabet's most recent annual report, they said that the continued increase to the cost of revenue has to do with traffic acquisition costs, which are basically fees paid to sites that host their ads. They also saw an increase in data center operation costs and content acquisition costs. Looking at Alphabet's business by its 3 main segments, the services business is clearly the most important part of the business, producing the majority of the revenue and profits. But this makes sense when you consider what Google services include, which is pretty much all of their major products you know Google for, like Android, Chrome, Gmail, Google Drive, Search, and YouTube. If we zoom in on the cloud and other bets chart, we can see the cloud business has grown at a pretty good rate. Revenue has grown from $6 billion in 2018 to tripling over the last 12 months to $15 billion. Another positive sign is the losses the cloud business has seen have slightly improved from $6 billion in 2020 to $4 billion over the last year. Alphabet actually breaks down the revenue even farther. We can see that ads are by far the majority of their revenue in their largest segment. YouTube ads are clearly growing, but it's going to be a long time before it comes close to matching Google search. What is pretty interesting is we can really see just how well Google is able to weather all of the concerns about advertiser budgets being slashed during COVID. Google search revenue in 2020 looks like they saw slightly smaller growth, but looking at the past year, which is the 2021 TTM column, taking 2 quarters from 2021 and 2 quarters from 2020, we've actually seen a huge jump in search revenue. Okay, so now that we've taken a look at Alphabet's business, let's take a look at the current valuation and see how it looks going forward. But before I do that, if you could just take 1 second to scroll down and hit the thumbs up button, I would really appreciate it. It helps me out a whole lot with the YouTube algorithm. So looking at Alphabet's forecasted earnings and revenue, we can see they're currently projected to keep going with the same growth we've seen. Alphabet's current net income is about $36 billion, and these are projected to grow by $81 billion by 2023. Revenue over the last year is $220 billion, and that's projected to grow to $337 billion by 2023. When we look at their annual revenue growth, Google has pretty much seen between 10 to 23% revenue growth, and the current forecasts are for that to slow down to just over 15%. Net income has seen pretty similar results, and analysts saw 2022 showing much slower growth, but they expect a return to the 15% growth rate going forward. Looking at these 2 charts, I think using a valuation based off a slightly more conservative 13% for a bottom-end growth rate, and for a top-end growth rate, I think we should use about 15%. When I go over to my PE calculator, a growth rate of 13 comes out to a fair PE value of 30. The top end number of 15% comes out to a fair PE of 36. When we chart this out, the current share price for Alphabet is shown in orange. The green area is a clearly undervalued stock, and the blue and gray area is a fairly valued stock. Anywhere above the blue is a stock price that's higher than the current valuation. We can see based off of Google's trailing earnings that they're trading at the bottom end of the fair value range. And based off the current price, by 2023, we could expect the stock to be worth somewhere between $3,600 and $4,400, which is 27 to 53% upside from the current share price. If we pull up macrotrends.net and look at the trailing PE ratio, we can see that Google has pretty much traded between 20 to 30 for the past decade. The only time we saw it rise is when they had a drop in earnings from a big European Union fine. So looking at this forward valuation, I could see them getting over 3,000 by the end of the year, and by the end of 2022, I'd expect about 3,500. The expectations for Alphabet for the rest of the year actually seem pretty low to me, and to be perfectly honest, I wouldn't be that surprised to see them exceed them by the end of the year. Now, Google is a stock that I currently own and will own for the foreseeable future. I do think it's an incredible business that deserves to be in anybody's portfolio as a buy and forget stock. I do think that the huge run-up is likely to slow down over the next year. I think what you need to ask yourself if you're looking to buy the stock is there enough upside for you going forward? Now, if you like this video, make sure you subscribe and hit the bell notification so you know whenever I upload a new video. And as always, thanks for watching.